Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have our EIA show today, and we have a lot to cover, as we always do. We'll try to get through it as quickly as we can. But we first want to do the first segment, looking at, we did get big builds. Is it something that's going to continue? Is it something that has happened in the past, especially seasonally speaking? Then we want to look at segment 2 and talk about how demand continues to weaken. But we do have February break next week. Typically we start to get a bit of a bump. People go away, you get President's Day weekend, you get February break. So that should provide that little kind of spike, and we want to go through. Is it something that, typically you spike and then stay elevated? Should we come back down? And those are some key pieces we want to look at. And then we want to look towards the futures market and the physical market and how they're similar, how they're different, and why we look at things at a barbell, not only looking at oil, but also at refined products. Because again, you have to compare the two of them, because if refined product prices are going down, builds are going up, well, you're not going to see a whole lot of new oil demand, because refiners take one, turn it into another. And if there's a lot of one, well, they're going to reduce the other. So we want to balance that approach and look at things, holistically and with an eye towards the future. So speaking with an eye towards the future, I think this is an important chart we just wanted to throw in one more time, is looking at U.S. capacity additions throughout the U.S. And ERCOT, I think, is an important one at this point when you look at how much wind and solar has been built. But gas continues to be built, but in a smaller format. And especially if you look at ERCOT, and if you look at where a lot of this gas is being built, it's on the coast. And that's a bigger problem, because when you start looking at, like, Devon reported a big gas number, and you're seeing a lot of, it's more the Delaware than the Midland, but the Delaware portion of the Permian is getting gassier, and there's not a whole lot of takeaway. And we do have a growing demand for electricity. The electricity demand is going up, and a lot of it is coming in by way of wind and solar. And again, there's a lot of intermittency between that. And because it's intermittent and you're going to need some backup gen, there is going to have to be some gas behind it. But if you're not building the pipelines necessary to support it, the turbines that are backstopping wind and solar are on what's called an interruptible contract, which means that in times of stress, that contract can be interrupted. So when you think about the stress, well, stress comes in high heat and when it's very cold, which is when demand for natural gas is going to be at its highest, which is when the wind may not be blowing or blowing too hard, sun might be shining, or not enough to make up for losses from the wind, that you get some of these back and forth. And that's why, we really have to look at that basket approach. I was lucky enough to be asked to do a show out of Africa, out of Kenya, where we talk about, energy consumption in Africa, how it's going to take to get built out. And, we look at things, and as those that follow me, I think there is a basket approach. I'm by no means saying that wind and solar should not be part of the solution, but we really have to consider weather, topography, and again, solar exposure, wind exposures, and how much gas should be built, because again, that is part of the solution. And I think that was a key theme and an important theme, because everybody was in agreement that natural gas really is a key component, especially when you start looking at the African markets. So now when we look at total oil and product stocks, you can see that we're hanging in just around the average. The deficit widened from 2.8 to 5.1, but given the builds today, we should see that again jump back into surplus. Total crude stock land and floating surplus now from 13.8 to 9.9. Some of that is because the floating came down. Some of that went into transit. We did get a nice movement from West African cargoes, which are starting to show up, and we'll talk through that in segment 3. And then total oil product stockpiles, the deficit now are from 16.6 to 15. And based on what we're seeing in Singapore, in the US, in Europe, we expect that deficit to continue to narrow, with a lot of that being driven again by the light distillate or gasoline front. Land storage for crude, deficit widened from 6.6 to 9.8, just below that average. West of Suez, the surplus narrowed from 4.2 to 1.3. Again, the surplus is going to widen. So we in the west of Suez, which again is going to move us essentially right in line with where we are normally. And that's one of the key pieces right now where, yes, it was a big build, but we normally get some sizable builds at this point in time. So there's really nothing to say that it's like, oh, oil's going to collapse to WTI is going to collapse to 60 now. It's like, no, we normally get sizable builds at this point in time, depending on when refiners go into maintenance season, how active have refiners been, and because light distillate and gasoline has been weaker, we've seen some weakness come into the diesel market. There's been no impetus for them to come back from some of their downtime. We've seen some of the maintenance pull forward, and that's where we sit today. West of Suez, the surplus narrowed from 4.2 to 1.3. That'll move. East of Suez, deficit widened from 10.8 to 11.1. And again, that's something that is going to remain wider, below average, but get a bit closer. Now, floating storage, the surplus now from 11.3 to 4. A lot of that was driven based on the drop in Europe and a drop in the U.S. West of Suez, the deficit narrowed from 4.2 to 1.6. Again, that's something that West Africa had a little bit of a bounce, but we've actually seen some new purchasing, which we'll talk about in a minute. And then east of Suez flipped to deficit from 14.4 to 1.9. And a lot of that was driven based on Asia, but we're going to go through that in segment 3 as well. So now looking at the U.S., you had a build of 16.28 million. And that was driven by, again, the Midwest continues to see builds as we've been talking about those flows coming from the U.S., coming from Canada down into the U.S. That's continuing. And then PADD 3, and it's something that we've been trying to highlight time and time again, is that there's that slowdown in refining, but again, there's that also that a bit of a slowdown in terms of the Asian markets. Europe remains strong, but consumption internally is just not where it was. You have some decent production coming from the U.S. Still they have it at 12.3. We have it a little bit closer to 12.4, but you're still producing a decent chunk. The exports slowed, maintained into Europe, slowed a bit into Asia. And you're pulling in, again, that heavier crude. You have some of that Venezuelan crude coming in with Chevron being active and bringing it back into the States. You have some of that flow down from Canada, and that's where we're seeing these builds. We should get builds this time of year, but we want to look at, what is the pace in general. And then obviously for those that haven't seen, there's going to be a release from the SPR of 26 million barrels. But it's important to appreciate that schedule was set in 2015. So the DOE tried to get it canceled. They ended up not canceling it. So far, they've canceled other sales because remember in 2015, there was a setup where sales were going to continue from 2023 to 2027. A lot of those sales were pulled forward given what President Biden did with pulling them forward. But now they've canceled a lot of the ones that were supposed to be between 24 and 27. This is one that they weren't able to cancel in time. But we do expect to see future ones in 2023 canceled because there are others that are supposed to take place. So again, this wasn't a crazy term. This isn't because, things are getting super bearish. They had the inflation number early, which based on where the inflation number came out, you could make that argument. But again, this was something that was supposed to happen. It was already slated, and given just the builds in the commercial market, there's really no need to continue down that path. Now, when you look at oil inventories for PADD 3, you can see that we've had a sizable build. The only time that we were here, 2017 was the only time we had more, and then obviously in 2021. But it's important to look that there's usually a point in time in February where you get a sizable shift. And it can vary based on when that happens. And here, typically it happens closer to the end of February when refiners go into their maintenance. That happens through March, and then they come back in April, getting ready for the summer driving season. And here you can see it started a bit earlier. So that's why the trend is going to be important from this point. Are we trending up? Did we get to this point and now we're kind of going sideways? You can still see there's a lot of crude in pad 3, but this normally happens at some point in Feb. It just happened to be a bit sooner. So here, when you look at Cushing, as we've been saying, we expected it to continue to climb. But look at other years. That it's not unknown to see a build at this point in time. And that's what we've been trying to say. It's like, look, this is all kind of expected within the normal advent of seasonality. You know, typically we thought things were going to be a bit faster, and obviously they've started to play out that way. But it's good to put it into context where, look, the builds are big, but they're supposed to be big around now, and they're continuing to go along those seasonal paths, you know, starting a little bit sooner because of refining. But again, nothing too crazy when you look at activity. Runs in the U.S. dropped 1.4% from 87.9 to 86.5. Still right around the 5-year average on a percentage basis. But when you look at runs, obviously because we've shuttered refiners, that has been reduced with the biggest amount coming from pad 3. And it's just you have some of this activity, some of these turnarounds happening a little bit earlier. And it's just because we've seen those builds, again, pick up in gasoline, picking up in the distillate side, and they're trying to balance their activity while also making sure that they do their maintenance so that they can get it and try to let the market clear a bit, and then turn on instead of, you know, early April, late March, you know, maybe mid-March, and trying to capture some of this adjustment that we're going to see, what they hope to see from the consumer and from the activity momentum. And this just puts it into context for refinery utilization rate. You know, we're coming to a point where you're normally getting drops. It's just we're already at the lower end, so we shouldn't see too much adjustment. We thought we could get maybe one more push to about 89%. Instead, we started to get a little bit of a drop, but it's not unheard of. We're right kind of in the average point looking at the last 10 years. So not too much to say one way or the other, with imports dropping broadly 824,000 barrels a day. But remember, we said that pad 3 had a makeup number, so we were going to see a bounce in pad 3. Pad 2 is going to fluctuate, but as we've said, it's going to stay above the 5-year average, which it did. And the biggest driver was pad 5, which is that lumpiness that we've talked about, and that's going to continue to be the case going forward. Imports into pad 3 were back above the 5-year average. You know, again, we think it's going to stay just below, and it's going to waffle back and forth. You know, not too much has changed there. Pad 2 dropping along those seasonal lines, still above the 5-year average. And as we've said, it's going to be at the 5-year to, you know, we don't think it's going to make new seasonally adjusted highs. It's just going to stay in the top end of the cloud, and we're going to continue to see that coming through. And that's going to provide some of that benefit for those pad 2 refiners that we've been highlighting. Implied demand, gasoline came down a bit from 8.4 to 8.27. A small drop of 154,000 barrels a day. But as we've been saying, you know, we expect it to be in this range. And we're going to show you that Gas Buddy had it a little bit higher than EIA, but Gas Buddy was lower last week than now. And it's going to be tough at this point, because as we go forward, you know, based on the end of this week into next week, you have President's Weekend and February break. So we should get a nice spike in gasoline demand. And that's something that normally happens. So we want to look at how does that pair up against the seasonality, and how much do we drop back down. Distillate had a small increase of 132,000 barrels a day, still continuing to be kind of that waffle back and forth. Jet had a small drop of 101,000 barrels a day. We should get a nice spike just because, again, February break is a lot of airports and elsewhere are going to pull in jet fuel this week to make sure they have it available, because a lot of people go on vacation next week, so that's something that is expected. Resid, nice bounce, but again, that's something that we think is going to fade, with propylene dropping 821,000 barrels a day. A lot of that is driven by the warm-up, as well as the continued slowdown in petrochemical demand. And then when you look at U.S. gasoline demand, you can see that there's normally that spike that normally happens. And it usually depends on, obviously, when does February break fall. And it can fluctuate, so it's just where does it match up? And you can see that we normally get a nice spike either now or next week. So we should be getting an increase. So when we do get one next week, it's not going to be this huge hurrah, here we are, we're back to normal. It's kind of that normal piece, and it's still going to be at the lower end of that spectrum. Crude oil inventory in the U.S. Crossing over 2021, moving in line with 2016, and again 2017, the only time it was higher. But you can see we normally get a little these increases. So it's just a matter of when did they happen, and it happened to happen now. Again, it's just, are they going to continue to this degree? And if so, what is the big driver behind it? So now when we look at total U.S. commercial oil storage and products, continuing to normalize, and a lot of that is just from some of that slowdown on the disti gasoline front and some of the sizable builds, but we're still just moving back to what is normal and less about into a bigger, broader surplus. It's just what is the trend, and the trend continues to show some sizable builds, especially on the product front, which is going to put us back to where we were in that 2019-2020 level. Days of supply came down a bit. They're going to bounce again just based on the builds. This is on a bigger lag. And again, but you can see we're still at the very high end of that. And then gasoline storage, again, trending up. And we should get a drop, which you can see normally happens, or at least kind of a flat line rollover, if you will. But that's going to just be in line with, again, February break, some of that pull through, which is expected as usual. Distillate came down a touch, again, just kind of waffling around here. The biggest component is we had a counter-seasonal build, and at this point, we think that the rate of change is going to be fairly stable with seasonality. It's just we're going to stay at a lower end of where we normally are, and a lot of that is going to be driven by the reduction in underlying refinery utilization rates, which yet continuing to climb up, and it's just going to be that balancing between kerosene, distillate, which is going to continue. When you look at the curve is fairly fixed, not too much adjustment in general. We continue to be in contango. That's something that we think is going to play out continuously, but we don't see too much fluctuation at the back end of the curve, just more on the front month in general. And then floating storage, small increase. Again, we just expect to see that to kind of manage storage levels, so we don't see too much adjustment in general. We do have some additional flows coming from West Africa. Iraq, actually, they raised their OSPs, but by no means as much as Saudi. So we should see some additional flows from Iraq coming in, and that'll again be on the heavier side. We've seen additional from Venezuela, and that's again keeping us above where we were last year. And again, we think we're going to be more normal on the floating storage side as some of that balances out in general. So that's what we have for you in on segment one. Segment two is going to be a bit bigger. We want to go a bit bigger, and just in terms of some of the new data sets that we thought were quite interesting on some of the trends that we're seeing and how that's going to impact demand really for not only just 2023, but for the foreseeable future.